Hello everyone. We're going to take a look at lesson 3.05, the Fed and monetary policy. So in 3.04, we looked at the structure of the Federal Reserve. Now we're going to take a more in-depth look at monetary policy and the tools of monetary policy. Monetary policy is what the Federal Reserve conducts to control the money supply. If the money supply increases and there's more money out there, then it should be cheaper to get that money. And if we remember, the cost of borrowing money is interest. So if the Federal Reserve increases the money supply by using expansionary monetary policy, the money supply increases and interest rates drop. And interest has a dramatic impact on you for when you borrow money for, student loans, car loans, house loans, things like that. So the objective in this lesson is to make sure that you understand the three tools of monetary policy and the goals of that monetary policy, and then to be able to explain how the Federal Reserve uses monetary policy to promote their national economic goals. Remember, those economic goals were low unemployment, around 4% or so, and low stable prices with a 2% inflation rate. So let's go ahead and jump into it. So expansion versus contraction. Now, you're going to see that the Federal Reserve will expand or grow the money supply when we're in a recession. So we want to have more money in the economy during times of recession, because then people are more likely to spend that money. And if they go out and spend money at grocery stores and at home goods stores or basic consumer goods, those businesses will be able to stay open. They'll be able to hire more workers. They'll hire more employees, and those employees will then get paychecks, and they can go out to different stores and buy more stuff, so the economy can grow. But the Federal Reserve will actually want to shrink the economy and have less money out there, decrease that money supply, if we have a problem of inflation. If there's too much money out there, if prices are rising too rapidly, we'll see that the money supply will actually want to decrease. The three tools of monetary policy are going to be your discount rate, which is that interest rate at which the Federal Reserve loans money to other banks, the reserve requirement, which is the percentage of money banks have to hold on to from their deposits before they can lend it out. That one's a little tricky here. When you take money like cash and you deposit it into your checking account, let's say you deposit $100 into a bank, and the bank has a reserve requirement of, let's say, 10%. That means the bank has to hold on to 10% of that $100 you gave them, and then they'll be able to lend out the remaining 90% or $90 of your deposit. So when you deposit money into the bank doesn't just hold it, they lend it out. And they want that money to be lent out. They want it to be circulating through the entire economy so people keep buying stuff. Last one there is open market operations. It's the buying and selling of government bonds, the treasury bills. You guys might have a government savings bond, an e-savings bond, or know someone that does. That's how the government borrows money, additional loans. So oftentimes when the government is going into debt, they'll issue out bonds. Bonds are pretty much nothing more than an IOU. So you can go through and read about why the bank would need to borrow money from the Fed, and how these different tools do impact you. But the biggest thing of the impact is going to be a lot of the interest rates. I just explained, I gave an example here of that $100 bill being deposited into a bank with a 10% requirement, and then how the banks can lend that money out and create new money. This is an example that kind of walks you through it step by step, and this is the math behind it. And then in real world application, recently you saw that during the pandemic, the Federal Reserve lowered their reserve requirement up from it used to be around 3%, and they lowered it down to 0, which means banks don't have to hold on to any of your money. They can lend it all out, so they can grow the money supply to basically an undefined amount if necessary. Now we can take a look at testing your knowledge of the different tools. So you could say, all right, the Fed blanked the discount rate to slow inflation. So to decrease inflation, you're going to want to see that the Fed will raise that discount rate. When you increase the discount rate, it makes it more expensive to borrow money, so banks borrow less. And you can click through all these here and get a better understanding of what's going on. Then they have a real life example, and I've been talking to you guys about how interest rates can impact you. This is a real life example of how interest rates would have a dramatic impact on how much you'd have to spend. This is an example of if you were to borrow money to buy a $200,000 home. Back in 1981, interest rates were around 15%. In 2021, around 3%. So how much interest would you actually end up paying can be drastically different for that same $200,000 home. So the Federal Reserve does have the ability to dramatically impact you. All right, moving on. They have a quick YouTube video here. I think it's only like 3 minutes that goes through and explains what are the differences between fiscal policy and monetary policy. And you'll need to watch this as a review because it will help you for your assignment. The assignment's going to ask about fiscal policy tools. Down here, they give a nice chart for you to explain what are the tools and the impacts and when they would want to do them, and what are the time lags between the two different policies of fiscal policy and monetary policy. And then they explain why monetary policy is kind of difficult to evaluate. Remember, fiscal policy is directly changing government spending. Like we're magically creating a job. We can just hire more workers, or we can just cut the taxes and give people more money and they can go out there and spend that tax break. But with monetary policy, we're just lowering or increasing interest rates and hoping people will borrow more money or borrow less money. It's just really a hope. We're not forcing anybody to spend more money or spend less money. We're kind of hoping. Monetary policy is kind of a hope that they'll change their behavior, whereas fiscal policy is a direct, hey, we're changing behavior, we're going to build a road, or we're not going to build a road with that government spending. It's right away. You can click through some more different examples there. This brings us to our actual assignment. So the assignment itself, you can click on this template and you're going to basically fill out the template and answer all the questions for it. These are the steps here for the template, but the template is actually pretty detailed. So if you click on template, it brings this page up. And you'll fill this page out. So you got your name, and then you have 3 different scenarios, and you'll have to answer these questions about these scenarios. So you'll read through the scenario and answer, would the Fed address the scenario with expansionary or contractionary policy? And then you got to explain why. You got to explain the why. Then, what specific tool would the Fed use? Then identify that tool and how they would use it. Would they increase the discount rate, or would they sell bonds, or would they lower the reserve ratio, whatever it is, and then explain how that scenario, or how this would address the scenario, like how would that impact scenario A over here. And then lastly, what would be a specific fiscal policy action that Congress might use? Would they increase government spending, or would they lower taxes to address scenario A? So you got to do that for A, B, and then C for each of those scenarios, answer those 3 questions. Then lastly, in step 2, you're going to explain which type of policy, whether fiscal or monetary policy, do you think is more effective in today's economy? And then explain your perspective. Why do you believe that? referencing some sort of event in the last 10 years. So, our pandemic that has occurred in the last 10 years, writing about that. And you got to do it in at least one complete paragraph. Then just, make sure that you're good to go there. All right, that's it. Hope that helps. Take care.